Welcome to The Explainer. You know, today we're going to break down a classic showdown in the world of dividend investing, SCHD versus VIG.
So, if you're trying to build a portfolio that kicks off some real income, I'm willing to bet you've stared this question right in the face. They're two of the biggest, most popular dividend ETFs out there, but they play a very different game. So let's dive in and figure out which of these champions might be the right one for you. All right, first things first. Let's set the stage for this friendly little competition. We're talking about two absolute titans of the industry, both built to give you a piece of America's most solid, dividend-paying companies. But here's the thing you really got to get right from the get-go. Even though they both love companies with strong dividend histories, their strategies for how they do it are fundamentally different. It's really all about income today versus growth for tomorrow. Okay, let's dive in. Time for the tale of the tape for our two contenders. Let's see what they're really made of.
You know, at first glance, you might think they're practically twins. So think of SCHD as like the income heavyweight of the ring. Its whole game plan is to screen for about 100 U.S. companies that don't just have a history of paying dividends, but also have super strong fundamentals and a really high dividend yield right now. It's built to deliver some serious cash flow today. Now, VIG is a totally different beast. This is our growth champion. It's got one main rule, and it's a big one. A company has to have hiked its dividend for at least 10 years straight. No exceptions. It cares way less about how high the dividend is today and way more about that relentless, steady growth year after year after year. Okay, so this is where it gets really interesting. Let's pop the hood and see what's actually powering these two ETFs. And trust me, the differences are pretty striking. And boom, this chart just says it all about SCHD's personality, doesn't it? It has a clear, undeniable value tilt. You see all that exposure to those classic cash cow sectors like financials, industrials, and consumer staples. You know, the kinds of companies that are famous for paying out a big chunk of their profits to shareholders.
Okay, now let's flip over to VIG, and you'll see a completely different world. VIG leans way more toward growth. Its biggest sector by far is technology, followed by industrials and healthcare. We're talking about companies like Microsoft and Apple. I mean, these are absolute giants that are still growing like crazy and bringing their dividends right along for the ride.
All right, for all you income seekers out there, this is the number you've been waiting for. SCHD's intense focus on high-yield stocks gives it a dividend yield of around 3.7%. That's a lot higher than the overall market and a huge draw for anyone in or near retirement. VIG's yield, on the other hand, is a bit more modest, sitting around 2.0%. And that totally makes sense, right? This reflects its focus on companies that are plowing more of their cash back into the business to fund future growth instead of just paying it all out to you today. But wait, here's a really fascinating twist in the story. When you look at how fast those dividends have been growing over the past decade, both of these funds are absolute powerhouses. In fact, SCHD has actually grown its dividend a little bit faster, averaging an incredible 11–12% growth per year. VIG is right on its heels, compounding its dividend at a really strong 9–10% annually. So, okay, we've got two different game plans, two totally different portfolios. The million-dollar question is, how's this all shaken out in terms of actual returns for investors over the long haul? So if we look at the 10-year total return, and remember that's price growth plus all those reinvested dividends, SCHD has actually squeezed out a small win over VIG. But it's really important to see that both of them have lagged the S&P 500, and that's largely because the S&P has just been on this incredible tear, led by a few mega-cap tech stocks that just don't fit into either of these dividend strategies.
But you know, performance isn't just about the good times, right? It's also about how you handle the bad times. It's about risk. Because it's more concentrated in those cyclical sectors, SCHD can be a bit more of a roller coaster. VIG, on the other hand, with its stable of huge dividend-growing companies, has historically been more of a defensive player, which means it tends to hold up a bit better when the market gets rocky.
So, at the end of the day, after we've laid out all the evidence, how do you make the final call? Well, it really truly comes down to your personal goals and your timeline.
Let's make it simple.
SCHD is probably your guy if your number one goal is getting the most cash in your pocket today. If you're retired or getting close and you need that portfolio cash flow to live on, that higher yield is going to make a massive difference. But if you're playing the long game, VIG is probably where you want to look. If you're a younger investor with decades to let your money work for you, VIG's whole focus on consistent compounding growth and the stability you get from those mega-cap stocks is just incredibly powerful. But you know what? Here's one last idea, a final little twist. Maybe you don't actually have to choose. What if you owned both? Think of it like creating a power couple in your portfolio. You get that awesome, higher immediate income from SCHD, but you also get that steady, compounding growth engine from VIG. Plus, doing this gives you much broader sector coverage and just a more diversified, balanced dividend strategy overall. And hey, to pull this all together for you, here is the ultimate cheat sheet. You can really see those trade-offs right here, side by side. You've got SCHD with that higher yield and value focus versus VIG with its broader portfolio and obsession with growth. Go ahead and pause here if you want. Take a good look and see how they stack up on the points that matter most to you. And that really brings us back to the one crucial question you have to ask yourself. The choice between SCHD and VIG, or even using both, forces you to decide, what's your portfolio's main job? Is it a cash machine for today or a wealth-building engine for tomorrow? Your answer to that question, well, that's where you'll find your champion.